Hey guys, hope you're having a great day. Tim back in the Revolved Realty Studio. Today I want to talk about this. I have been hearing a lot of buzz lately from folks who think that because of the coronavirus that we are headed into another housing crisis like the one that we saw in 2008. And of course, my opinion is that is not the case. We are not in a housing crisis. We are in a health crisis. And I wrote about this in a blog post recently, and I just wanted to do a video to kind of back that up and hit a few of the high points, just to argue the point that this isn't 2008. We are not headed toward the housing crisis that we saw then simply because Corona is here. Folks are doing forbearances, and there's not the money flowing that was recently. The first thing you have to realize is what caused the housing crisis of 2008 and the start of that entire recession, if you will. You know, I'm no expert, but it's my belief, in my opinion, that the housing crisis came from a couple of reasons. Number one, predatory lending practices at private mortgages. There was an unregulated market where just about anyone could get a home mortgage. And out of that became the growth of the subprime mortgages, where they were loaning money to people that weren't qualified and people who probably couldn't even make the payments. And when all of those loans were called, it crashed. Now, again, I am not a financial scholar by any stretch of the imagination, but I believe that's what's happened. Simply the fact that people who were not qualified for mortgages were getting mortgages, were getting multiple mortgages. There was a thing in the news about a cocktail waitress in Miami who had mortgages on $6 million homes. Okay. So I think that's what caused the housing crisis in 2008. But look where we are now. Let's talk about a couple of other things. And I'm going to pull some graphs. There was a survey done recently that looked at the aspects of where we are now and where we were in 2008. And that's what I want to talk about. Number one, when we look at the appreciation in this graphic, there's a big difference between the prior 6 years up to 2008 and the last 6 years to where we are now. If you look at that, leading up to the crash, there was a much higher appreciation in the country that we see today. In fact, the highest level that we're seeing today is actually under the lowest level of it was in 2008. If you look at that, the appreciation was up into 12.5, 11. Now the highest appreciation we've had in the last 6 years is 6.4%. So basically what this says is we don't have runaway appreciation. And really appreciation is kind of a smoke and mirrors kind of thing anyway. You know, we're not seeing houses go from being worth $100,000 to $500,000 over the course of a few years. So there is no runaway appreciation right now. Things are appreciating at a normal scale. Next, let's look at mortgage credit. The Mortgage Credit Availability Index is the monthly measure by the Mortgage Bankers Association that gauges the level of difficulty to secure a loan. How hard is it for the average Joe and Jane American to get a loan? The higher the index, the easier it is to get a loan. The lower the index, the harder to get a loan, meaning that you've got to qualify for the loan. Back in 2008, if you had a pulse and a driver's license, you could get a loan. We're nowhere near the levels that we saw then before the housing crash when it was so easy to get a loan. However, lending standards have tightened, and they have remained so leading up to today. A lot of changes came out of the housing crisis, especially in the mortgage industry. And I need to get my friend Stephen Allen with Caliber Home Loans in here to talk about this. But if you look at this graphic, the housing bubble, the index was at 868%. I mean, if you had a pulse, you could get a mortgage. Today, it's much lower at 152.1. So if you look at that, you can see that things have tightened up. You actually have to have income, debt to income ratio in order to buy a mortgage or to get a mortgage. And again, part of the reason the housing crash in 2008 was it was so easy to get a mortgage on a home. Number three, the number of homes for sale. Now, if you look at the graphic, one of the causes of the housing crash was an oversupply of homes for sale. Basically, the market was glutted with homes for sale. Today, we see a much different picture. We talk about it all the time on this program, how we are at a 20-year low in inventory here in Madison County right now. We don't have enough homes on the market versus the number of people who want to buy them. It really is a seller's market. So across the country, we have less than 6 months of inventory and undersupply of homes for interested buyers. So as you can see, it is a seller's market. It is not a buyer's market. Therefore, the number of homes available is far less, and it's harder to get a mortgage. Number 4, the chart shows the difference in how people are accessing the equity in their homes today as compared to 2008. We're going to do another video talking about the amount of equity that Americans have in their homes. I think you're going to be surprised at how much equity we're sitting in. But in 2008, consumers were harvesting equity from their homes through cash-out refinances. Now, we're seeing a lot of refis now, but it's mainly because the interest rate is so low. People are refinancing their existing home balance. Consumers are treating the equity in their homes much more cautiously. So if you look at the graphic, you can see back in 2007, 2008, the 3 years leading up, there was a total of $824 billion in refis. Wow. If you look at the adversely now, 2017, 18, 19, right now, $232 billion. So a fourth of the refis. So that is really good news. The home equity, 53.8% of homes across the country have at least 50% equity in their homes. People are not tapping that equity as much with the home refis or the HELOCs. And again, what that means is if you've got a lot of equity in your home, you're not going to walk away from it so easily. That was one of the things back in 2008, man. They were foreclosures left and right. People had gotten a first mortgage on their home, then they'd gotten a second mortgage. They basically pulled out most of the equity, and if they couldn't make the payment, they just walked away. So the bottom line is this. The COVID-19 crisis is causing challenges across the country, more so than the ones we faced back in 2008. But you got to understand, back then, it was a housing crisis. This is a health crisis. And because it is a health crisis, we are going to recover much faster than we did then. I'm going to be doing a video that is a little off topic on real estate, but it does go with the coronavirus theme and talk a little bit about the unemployment that's going on. And they are saying that with everything that's happened with our economy over the last few months, we are going to recover much quicker than we have in the past when these similar crises have hit. So there you go. Keep in mind, we're not in a housing crisis. I hear so many people, the sky is falling, the mortgages are going to go away. It's not the case, guys. We are in a health crisis. We will recover from this quickly. The mortgage industry is in nowhere, shape, or form similar to where it was in 2008. So I understand that some folks are worried, but I believe you can rest assured that this isn't a housing crisis. It's a health crisis, and we will recover much quickly. I need to get Stephen Allen here on the program. Stephen is one of the sponsors. He is the area manager for Caliber Home Loans. We call Stephen the Miracle Man because he can get a home mortgage when no one else can. I'm pretty sure that gets on Stephen's nerves, but I like it. So whether it is a new mortgage, a refi, or a construction loan, VA, FHA, Stephen does it all. Give him a call at Caliber Home Loans today. If you mention to Stephen that you heard about him here on the program, he is going to do your home appraisal absolutely free. That's about a $450 value. The other sponsor we work with quite a bit, Jacob Title, that is Stan McDonald, Sam Hawkins, and the entire team at Jacob Title. No one in town gets your home closed quicker, faster, more efficiently, dots all the I's, crosses all the T's. When you get to the closing table, you know things are going to go just fine when you close with Jacob Title. And if you mention to Stan that you heard about him here, he's going to knock $100 off your closing costs. So there you go, guys. It is not a housing crisis. It is a health crisis, and we will recover and get back on track in short order. If I can do anything for you, please give me a call, 679-0704, tim@revolve.com. I work with buyers and sellers here in town, work with a lot of investors, anything pertaining to real estate. Give me a call. Be happy to help you out. All right, that's it. Get out there, stay well, stay safe, stay happy. See, I've got a tagline too. I just can't remember it. I'll talk to you soon. You guys have a great day.